Good morning. I'm Reena Agrawal. I'm the director of the Georgetown Center for Financial Markets and Policy, also the Robert E. McDonough Professor of Finance, and I also wear the hat of Vice Provost for Faculty for Georgetown. We are absolutely delighted to welcome you to the Financial Markets Quality 2017 conference. This has become quite a signature event for us, and our partner has always been and continues to be the Financial Times. We are delighted to be partnering with the FT once again for this event. As most of you know, Georgetown University is one of the world's leading academic and research institutions. We offer a transformational educational experience that prepares the next generation of global citizens to lead and to make a difference in the world. The mission of the Georgetown Center for Financial Markets and Policy is to provide thought leadership for global finance. The center offers innovative, influential, and thoughtful commentary. We conduct relevant research that impacts practice and policy. We truly believe in excellence in research to impact practice and policy. We host dialogues and conferences such as this one involving scholars, practitioners, and policymakers on key financial market issues. Georgetown has always been a very global institution. That, combined with our location in Washington, D.C., makes us quite unique. At the same time, we are a Jesuit and Catholic university, and we believe we have a responsibility to the global community. And the center is trying to combine all of those aspects of Georgetown, and this conference is evidence of that. So the center contributes to an informed, solutions-oriented discussion regarding critical issues faced by global financial markets. We really do believe that it's the responsibility of Georgetown to provide unbiased analysis that can both guide market practices and at the same time help policymakers. Just to give you an idea of some of the recent activities that the center has been involved in, we obviously cater to our students. We hold a Careers in Capital Markets events for our students, and that packs this auditorium. Our students are very interested in finance, but they're also very interested in doing good. And finance is a lot about doing good. So we do need the best and the brightest to go in finance and do good at the same time. So the center helps bring these students into the financial sector. And we conduct congressional policy briefing series on Capitol Hill with the Milken Institute. And the idea is to sort of educate senior staffers on issues that they're going to be forming policies about. The center has really had very strong participation from the Washington institutions like the World Bank, IMF, SEC, CFTC, the White House, Treasury, all of the, I think of Washington as not just the nation's capital, but it's really a global capital, and finance is global, so we're very well positioned here. I want to take this opportunity to thank our sponsors and our participants. I'll start off with the London Stock Exchange Group and FTSE Russell, New York Stock Exchange, CBOE, NASDAQ, GTS, Thesis, BATS, now CBOE, Invesco PowerShares, State Street, BlackRock, Deloitte, PwC, KL Gates, JP Morgan, Cantor Fitzgerald, Williams & Jensen, Thomson Hein, Block, FINRA, SEC, CFTC. We have an amazing group of partners who have helped us in so many different ways. And today's program is going to be pretty amazing. We're going to hear from some terrific leaders in the industry. And I invite you to learn more about the center by visiting our website. And as my colleague John Jacobs, whom you'll meet later, says, there are only two groups in the audience today, in the room today, those who support the center and those who will be supporting the center. So we look forward to your participation. And at this time, I'm going to pass it on to Professor Turan Bali, who's going to introduce our keynote speaker. Turan.
Thank you, Rina. Thank you all for coming. I am delighted to introduce our keynote speaker, Mark Makepeace. Mark is the Director of Information Services at London Stock Exchange, and he is the founder and chief executive of FTSE Russell. Mark has an incredible resume, which is difficult to summarize in a short time, and I have no intention of stealing his time. So without further ado, I'd like to invite Mark to the podium.
Thank you, and good morning, everyone. And thank you to Rina in particular. I also was going to thank John Jacobs. A little story before I talk, but John had a very main cause for why I'm still working in here today. And that's because I have 3 children who grew up in the UK. And my daughter, who's the oldest, wanted to be in journalism. And the FT, who were a partner of FTSE, they were a joint venture partner, she had a week of work experience with the FT. She met with the editor, she sat in the editor's meetings. John Jacobs then offered her a week at the NASDAQ Media Center in Times Square. Her mind was made up. She went for NASDAQ America, and because of that, all my 3 children have been through universities in the US, so I'm still having to work to pay that off. So I'd like to thank John for that. It's also an honor to be invited by the Centre to join you today. In a brief introduction, it said I founded FTSE, and I did back in the late 95. And actually, we were very much a startup, and startups are very fashionable today. I can tell you at FTSE, 9 people in an empty office. It was less fashionable in those days. But the experience of going from a very small company and growing that into a global business has given me a lot of sort of insights in business. And before FTSE, I did work at the London Stock Exchange and helped coordinate Big Bang, and that was back in 85, 86. So you can probably see I've had a long time in the markets studying them. I now serve on the executive committee of the London Stock Exchange Group, but I'll talk about stock exchanges and what I think they have become and are becoming, because I think there are some very important changes. In fact, there are 3 themes which I'd like to cover this morning. The first one is about the changes that are happening in the financial markets, and there are profound changes that are happening. The second is the evolving role of global exchanges. And I really do believe the concept of the national exchange is one which is something of the past. And we are now talking about very much global exchanges, and I'll talk about that. And then lastly, I'll talk about the growing importance of benchmarks and the index providers. But first, if I talk about the profound changes in financial markets, if I may, I'll provide a sort of global perspective on changes we see taking place in financial markets around the world. As you are aware, the markets are going through a period of profound change. Low economic growth, cheap money, and new emerging technologies, coupled with changing regulatory structures, changing market structures and regulatory shifts, political change, they've all combined to create a very dynamic landscape. And as a result, all market participants, both the buy and sell side, face multiple challenges as business models change across the board, from fee compression and constraints on capital to liquidity pressures and disintermediation. What I believe is driving a lot of this is the expectation of low returns. And if you think we've had the S&P 500 at record levels now for some time, but there still remains this expectation of low returns. And that really is driving the behaviour of institutional investors and retail investors who are seeking not just to invest in passive vehicles, but low cost. So active managers are having to reduce their fees. Hedge funds are having to really justify fee levels. And passive funds, even passive funds, the money flows are into the cheaper passive funds. So really it's the Schwab, the Vanguard, and the core products of iShares, which are really collecting the majority of the money. And also I'd make the comment that 10 years on from the global financial crisis, all of us in the financial services industry still need to continue our efforts to rebuild trust in our industry. And we need to continue, I think, to build on the global standards of regulation that came out of the crisis with the aim to keep the world safe. These forces are changing the way our money is managed. Investment flows are predominantly into low-cost passive funds. Active managers are having to take more active bets rather than hug the benchmark. And they have to justify higher fees and deliver meaningful outperformance. And if you're on the sell side today, you need to find ways to manage capital much more efficiently and drive down operating costs. This is all happening within an increasingly globalized marketplace where regulatory forces around the world are accelerating the pace of change, driving the need for greater transparency and improved risk management. We are all adapting to an environment that is significantly more competitive and becoming even more complex. These forces are driving the need for more globally integrated services, which can only effectively be provided by global financial market infrastructure companies. Global scale has real benefits for market participants. Deeper liquidity pools in our capital markets help keep down investment capital costs, just as in clearing, global liquidity pools keep regulatory capital costs down. So let me turn to the changing role of global exchanges. Given these profound changes in global markets and the specific challenges our customers are facing, the role of the national stock exchange itself is evolving. We are becoming global financial market infrastructure providers. In fact, we've even got a sort of a shorthand way of referring to this. And learning to compete, and this is an important part, learning to compete for our clients' business. The core providers, so the trading venues, the post-trade service providers, the information companies and technology businesses, they're all competing in the race to lead this new industry. And the demands for ever more data and the adoption of new emerging technologies are reshaping our industry and mean that the future winners in providing market infrastructure services must be innovative and agile. But they must also have global reach and global scale. At the London Stock Exchange Group, we embarked on a global diversification strategy some 10 years ago to expand beyond a UK-based stock exchange to serve the entire pre- to post-trade space. And in fact, the old sort of national London Stock Exchange is now one of the smaller parts of the group. In 2008, we began building our technology assets and expanding our trading businesses to cross-border equity and fixed income venues and multilateral trading facilities. We created the leading multi-asset index and information business through FTSE Russell and added clearing services in the form of LCH, the global leader in OTC clearing. We now have over 5,000 employees located in over 18 countries worldwide. including, we have in fact over 700 staff in the US. And all of this is to serve our global customer base. We touch market participants in all parts of the value chain, raising capital, defining investment strategies, creating and selecting investment products, executing and processing trades, clearing and settlement. And because we touch on so many of the global markets, our relationships with regulators around the world are very, very important to us. We need to foster trust in the financial markets and make the world a safer place for market participants, engaging at every level with regulators and policymakers. And we need to think differently about our customers. Many organisations provide global financial services. What we try to do, which we hope makes our model different, is that we try very hard to partner with our clients, even if this means working with our competitors. And we've called this approach open access. And open access seeks to put customers at the heart of our model and how we do business every day. We believe fundamentally that our customers should have a choice of where they list their companies, trade and clear. In essence, it means choice for customers and incentivises infrastructure providers to deliver the best services to attract them. Competition has lots of positives. And for example, you can trade FTSE and Russell index derivatives on CBOE, ICE, Euronext, CME and SGX. Or you can connect to investors and raise initial investment for a startup on our Elite Connect platform. But then you can go list your successful business on the NYSE. So exchanges are changing. But let me now sort of say a few words about the growing importance of benchmarks and global index providers, because I think this is an industry that now gets a lot of comment. The index industry, like many other industries, has been consolidating. There are three major index providers, or players: FTSE Russell, MSCI, and S&P Dow Jones. They service asset owners and institutional investors worldwide. And between us, the three of us, we have almost $40 trillion in assets that follow our benchmarks. And we can monitor this through public services such as Morningstar and eVestment. But we actually believe there's more than that, but that's what we can see. Of that $40 trillion, FTSE Russell has some $15 trillion following its global benchmarks. And that figure, and I'll just mention this because I think it's pertinent, that figure breaks down roughly into 80% covering equity, 20% covering fixed income markets. And as the banks exit from providing fixed income benchmarks, I'm sure you'll find a greater percentage of us and MSCI and S&P Dow Jones will cover the fixed income markets. But in terms of those assets that follow our indices, 79%, so almost 80%, is actively managed funds. We actually make more money from active managers than we do passive funds. Only 21% is passive. And in fact, if you look at the bond market, if you look at emerging markets, you'll find much lower levels of passive investment. It's only in the more developed markets, such as the US and the UK, will you see higher levels. But even in those markets, the level of indexation is still just below 30%. So that means the vast majority of the market is actively managed. And active managers trade far more than passive managers. Passive managers hold the market at the market rate. They follow the market. So they add stability. But active managers trade something like 10 times the amount passive managers trade. So if you think what drives market in terms of trading behaviours, it's very much more the active management side than the passive. Now, when you move into the bond markets and think about ETFs, where you've got ETFs on illiquid or less liquid assets, you know, you have some other challenges where some of those ETFs actually help create liquidity. But overall, passive is still very, small percentage of the markets, and likely to remain so. Because again, it's linked to investors' perception of returns. If those perception is that returns will remain low, they will continue to invest in lowly priced vehicles, which includes indexation. So there are also a large number of index providers that provide very low cost, even free index calculation services, such as Bloomberg, Thomson Reuters, Morningstar. If people want an index, they can get it quickly and often at a very, very low cost. And coupled with self-indexing by asset managers, people like BlackRock and others, self-index, this is a very competitive market with a lot of choice for the end investor. But what makes the big three global index providers different is that the buy side is increasingly looking to us to help determine industry standards. Institutional investors collectively have a very large say in what people like us do and feel almost an ownership over our decisions on the indices and get very actively involved around our construction, our eligibility rules, our operational practices, and we in fact seek their input at every stage. Our transparent rules-based methodology is an essential part of our governance practices, and decisions are only made after extensive public consultation and dialogue with regulators and market practitioners worldwide. But we do this because we compete in the creation of industry standards. That's what makes someone like FTSE Russell different from a Thomson Reuters, Bloomberg, or anybody else who can calculate exactly the same index. Our core purpose at FTSE Russell is to help investors make better investment decisions. Again, this is the basis on which we compete. And we do this by ensuring that our construction methodologies and operating practices are recognised by institutional investors as being the best practice, and therefore becoming industry standards. Recent examples include our ruling on shareholder voting rights that established minimum standards for benchmark inclusion, as well as our decisions that relate to defining what is an emerging or developed market, and also which markets then become eligible to be included in global equity benchmarks. Billions of dollars will follow those decisions, but they'll only follow those decisions if they support and believe those are the right decisions. How we approach these decisions, therefore, is very important. For example, the inclusion of emerging markets such as Saudi Arabia and China A shares, which we've been deliberating over recently, will have a very significant impact on global equity portfolios and need to be managed with great care. And there is a huge difference between index providers who, through the benchmarks they operate, are working closely with institutional investors to set market standards for the investment community, and those index providers that create standalone indexes on which ETFs and various investment products can be based. The gap between these two will get larger, with the former being a global and scale business. So some examples just to illustrate this point. And sustainability investing is, it's been more than just a passion of mine. I started FTSE for good when sustainable investing was unfashionable back in the 2002. But today, that's changed. And we see sustainable investing as an issue which is rapidly growing in importance for investors and listed companies. And because we work with the world's biggest sovereign wealth funds and asset owners, we can see asset owners now choosing to adjust their benchmarks and global portfolios to reduce their exposure to environmental risks, such as climate change, and also to increase their exposure to companies and industries they believe will benefit from the move to a lower carbon economy. This is happening now and has been happening for the last 3 or 4 years, with sizable changes happening around the world. The energy and transport industries are good examples where investors are making these types of decisions. And if we look at new types of industries that are coming to the market, new companies coming to the market, in fact, what we can monitor and see is that the market value of what we call green revenues, now generated by listed companies, is similar in size to the total market value of all emerging markets. So let me finish by talking about emerging markets, because I also think this is a very significant area of change which will in fact affect policymakers. We cannot ignore the huge shifts in global economic development from the west to the east. The demographic shift to younger emerging markets is compelling, and these younger emerging economies, not the developed world, is where global investment will go in the coming decades. We are seeing a major shift in global market capital and development into emerging markets such as China and India, and this will only increase in the coming years. As the World Bank suggests, by 2050, around 50% of global capital flow will come from emerging markets, as compared to just 10% 15 years ago. The size of these emerging markets in the coming decades will have a major impact on global portfolios and where institutional investors allocate their investments. Emerging markets like China, India, and even Saudi Arabia and other parts of the Middle East will constitute a much higher percentage within global benchmarks, going from their current level, and this is total emerging markets, is about 6% of our global portfolio. But that's going to rise over the next 10 years or so to look more like 30 to 40%. So that's a huge shift. If you think of the China A-share market, which is yet really to be included in any global benchmark, if you think of Aramco and Saudi Arabia, if you think about the growth of India that's yet to come, this is a huge shift that's going to happen within a 10 to 15-year period. As a global index provider, we need to monitor these markets, which is what we're doing, for potential inclusion in our global benchmarks. And in fact, we have groups of the largest asset owners in the world that now meet regularly with us, and we update them on progress in these markets. The major regulators of these markets meet with us on a frequent basis to discuss their progress. So this is now ongoing. And we have to bring these markets into our benchmarks carefully, and we have to do this over time, so that these markets can handle the large capital flows and develop other important aspects, such as the maturity of their market structure and level of transparency. So to close, I'd like to stress again that the world is undergoing profound change, creating a more complex and challenging market landscape for our customers. These changing markets are in turn driving a change in the role stock exchanges play as part of global markets. We are becoming global financial markets infrastructure providers, and global scale is important. I believe we will see 4 to 5 truly global market infrastructure providers emerge over the next few years. For the London Stock Exchange Group, we believe it's critically important that we place our customers at the heart of our business, which is what we refer to as an open access approach. And finally, as global index providers grow in scope, I think it's important that we understand our role as standard setters for global institutional investors. Through our governance and benchmark policy decisions, we play a critical role in helping them make better investment decisions and to manage the global change in our markets. With that, I want to thank the Centre again and happy to take any questions. Thank you. Please.
I can speak loud. It's okay. Hi. Good morning. And thank you for your speech. And I'd also like to say thank you to the McDonough School of Business and Financial Times. Appreciate them hosting this. My question to you is, I'm an avid reader, obviously, of the Financial Times. And I'm constantly reading, I guess, the spreads, for lack of a better term, the differences between the sterling and the dollar, or the sterling and the yen. I'd just say, over the next for the past 3 months, I just noticed very little movement in the currency markets. Now, I know some people index with currencies, and they would do it obviously through the FTSE, but those small changes, percentages, even with the FTSE 500 and the FTSE 250, it just seems so minimal. I mean, to me, it's like the market is telling me something, but what it's trying to tell me, I just can't figure it out, for lack of a better term. So if you can offer any insight into that, and that'd be good, appreciated.
I should start the answer by saying that I'm an indexer, therefore we track and we only explain the rationale after the event, which is probably the safest thing to do. Look, I think currency markets, are changing. But they're changing for a number of reasons. One is some of the political uncertainty, and we've seen the pound, lost 20% for the Brexit vote. We see that the euro was affected by the Catalan independence vote recently. But also we've got this uncertainty as the change in direction with interest rates. So again, that's affecting markets, certainly in the currency markets. But I think there's a lot of uncertainty. In the same, if you look at Brexit, I think all of us can just see the negotiations that are going on. The biggest issue we have is just the uncertainty. None of us can see what the final outcome is going to be. So I think maybe small changes day to day, unless there's a real shock. But some of the currencies, are making quite significant changes, over, longer periods of time. And I think that's going to continue. Okay, thank you. Any other questions? Please.
Good morning. My name is Li Yang. According to your title, is so fantastic. So I just wonder if you can lead as a leader to really improve the competition. I think by competition, not just the interest going lower to benefit the financial sector, but rather should be lower to benefit all the general public, consumers and homeowners. Mm-hmm. And second is currently from local to federal to global, I think they use PPP. There's somebody called P3, somebody simply don't really understand what that is. A public-private partnership. I think that is misleading. Usually it seems to deprive our government sector at the expense of general public or taxpayers. I just wonder if you can really make it clear to all the financial industry, or they may be associated with the developer. Try not to do that. Currently, they simply spread everywhere, especially use the government agencies. I think that is really at the expense of general public, and that will be very much damage to our social society and families. So I wonder if we can really provide good leadership on this area.
Thank you for that question. I really think there has been, a huge cultural change, in financial services businesses, but it was needed, and I think it's still a change that, we have to continue to push for. I think what you've seen in markets recently, with products which are much keenly priced, with stronger competition, with trying to reach out and deal with issues on a global basis, and I do think that's very important. I think you are seeing an industry that is, only part way through, but is trying very hard to adapt to, today's environment. And today's environment, leaders, I think, culture is probably the top item on their agenda. And making sure that there is security in the market and markets are safe, but making sure that the way we all do business is done with the right attitude, I think is probably the most important thing that leaders can show through their behaviour and make sure happens throughout their businesses. And certainly at London Stock Exchange, we feel that very passionately. Okay. Thank you. Thank you very much, everyone.